And arguably the strangest year to ever invest in is 2020. It's difficult to traverse these treacherous waters if you have no idea what you're doing, which is why we're making this video, to offer a framework that will be beneficial. It won't turn you into an investment genius in one video, but it will put you on the right track to begin investing. So I will offer some of the top investor strategies to win in the long run.
Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started.
Number one, handle your emotions. This is the viewpoint that 90% of investors adopt. They're ecstatic when their stocks rise in value. They brag about how much money they've made to their friends at the bar. They do a weekly stock check, and their emotions get all wrapped up in the ups and downs of the stock markets, if not daily. The small number of investors, though, that perform the best do the exact opposite of those men. When equities fall in value, winning investors rejoice because it indicates that their stock has become less expensive, allowing them to acquire more at a reasonable price in the long run. Number two, have competence. According to Warren Buffett, in the marketplace, you're dealing with a lot of idiots. It's like a gigantic casino and everyone else is having a good time. Purchase low and sell high. Regrettably, the majority of investors do the exact opposite. Assume you wish to gain a competitive advantage over other investors. In that scenario, if you want to acquire those high level profits, you should invest in sectors you're familiar with. Therefore, I recommend that you take a step back and evaluate the areas in which you have experience, which may include gaming, AI, social networking, or any form of technological business if you're a young person. If you're older, your advantage might be in more mature businesses like hospitality, travel, wine, food, something with that nature. Like Buffett, he only sticks to those mature business models that he knows about. He knows the game so well that he can pick the company anytime. There are suitable investments, and you should be doing the same thing as Buffett and have a better idea than most of what companies are going to lead in the future and what industries will take off. That's also why I want to mention Peter Lynch's most famous quote, to be so simple but so genius. He says, know what you own and know why you own it. You see, most investors want to make money in every industry. They want to talk at the bar to their friends about all the companies they own, but rarely do they stick to the industries that they actually know. Well, rarely do they understand what they actually own and why. That's why you shouldn't be like most investors. If I just got a random person who'd never played poker before, and I said, do you want to join my friends and me for a game of poker? We'll put in $500. That person would be stupid if he said yes to the game because they'd never played before. And he was going to get slain endless. And if we can take that and apply it to the stock market, you will be amazed at how many beginner investors don't know the basics to investing. And what inevitably happens is they get slain one after the other, 1, 2, or 3 years later. So if you're new to this game of investing in the stock markets, particularly in these difficult times of 2020, 2021, here is some basics that you need to know. Like the PE ratio, it is one of the most crucial metrics to understand. It measures how much you pay for a stock relative to how much it's bringing in. Another thing is return on equity, which is great for measuring how efficiently a business generates profits. But do you know about some stock market orders? What a limit order is, a market order, a stop limit order? See, you need to know these things before investing. You have to understand the range of fundamental strategies that you can use, like Warren Buffett's strategy of value investing, buying a price at below intrinsic value. Do you know about the dividend aristocrat strategy, a group of stocks that you can dollar cost average into and beat the market long term? At least according to history. You must get your head around these fundamental strategies, these little tactics that you can use. Get your head around the PE ratios before you become an investor. This is one of the most straightforward rules to investing. But one of the most complicated rules to follow, most investors is obsessed with, is the day-to-day, week-to-week news of the stock market. The thing is, you get some type of dopamine hit every time you receive a piece of information. This leaves 90% of investors hooked on the short term, going to one of the stock markets. Now, I wouldn't have a problem with this, but it negatively affects the way you invest and ultimately your investing returns. One of the problems of looking at the concise term is that you don't notice the long term patterns you're going through. If you look at a week or even a month in the stock markets, these are usually tiny dots of a longer term wave. So, as an investor, if you are attached to the short term, you're going to make decisions based on that. And overall, it leads to worse investing returns. This is why Buffett says only buy something you'd be pleased to hold. If the market shuts down for 10 years, don't worry about the daily news and don't worry about the minute. The next thing you rarely want to be getting in your head around is market cycles, especially in the 2020s when we're in the latest stage of the process. Now, I'm talking about getting to know what stocks do well in which period. So, let me share a bit of an old school method which will help you do so. As you can see, transportation, technology, and capital goods stocks perform well during the early to middle stages of the market cycle. Why? Well, because things are beginning to grow. The economy is starting to pick up steam. As a result, transportation is more important. During these periods, technology stocks generally sell for a lot and they can soar, as if you had invested in Netflix, Tesla, or Amazon 10 years ago. It was the right time to do so as the market began to heat up. But during the later stages of the cycle, the more conservative stocks start to work better, like consumer non cyclical and healthcare. So, why is that? Well, because even in a market downturn, people still need to eat. They need toothpaste, soap, clean water, etc. So consumer non-cyclicals are safer to own. They also need their health taken care of, so healthcare stocks during the latter stages also work well. And this is what I'm talking about. As a beginner entering the stock market, you need to be getting your head around these things. You need to know what stocks do well and when as the same. You can buy the most substantial stock in the world, but if it's in a weak sector, you can lose it. You see, one of the reasons that I enjoy following Ray Dalio is that he provides historical information and connects it to current events to help us understand where we are in the market cycle. Then I'll be able to structure portfolios for market conditions in 2020. It began 10 years ago when the economy and market were still in their infancy, but at the end of the day, all you can think about are the current market conditions. And these tidbits of advice that I've shared with you will help navigate the waters for these unique market situations in 2020 and beyond.
Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.